The biggest threat to your investments isn't inflation, interest rates, or the next market crash. It's you. Not because you're careless, but because most strategies fall apart the moment things get uncomfortable. When everything drops at once, discipline is usually the first thing to go. That's the real problem Josh is trying to avoid here. He wants to build something he can actually stick with when markets stop behaving. In this video, I'm going to walk you through a simple Vanguard-based portfolio built around that exact idea. Each ETF has a clear job. One grows with the economy, one pushes returns higher when risk is rewarded, one keeps things steady when markets get messy. And at the end, I'll show you Josh's 3 Vanguard ETF portfolio that can potentially turn a $7 daily investment into a retirement portfolio worth over $1 million. To see how and why this works, we first need to look at the environment investors are actually facing. The first force everyone runs into is inflation. It's unavoidable. Inflation sets the baseline just to break even. If prices rise 2 or 3% a year, your money has to grow at least that fast just to stand still. For Josh, doing nothing isn't playing it safe. It's a guaranteed loss of purchasing power. Over time, that adds up. U.S. inflation data going back to 1928 shows that inflation has averaged roughly 2 to 3% per year. Some years were calm, others weren't. In the 1970s, inflation surged. After 2008, it picked up again. In 2021 and 2022, it spiked sharply. The pattern stays the same. Even small annual losses compound into a meaningful hit over decades. Stocks exist for this reason. From 1928 through 2023, the inflation-adjusted performance of the S&P 500 increased to approximately 6,849 on a real return index basis. This growth absorbed repeated crises, including multi-decade depressions, financial system failures, and global shocks. Annual returns were highly uneven. Gains exceeded plus 40% in strong years while losses approached negative 40% during severe downturns, such as 1931, 1974, and 2008. These declines were not rare events. They were structural features of stock markets. Yet despite frequent volatility, long-term real growth remained intact for investors who stayed invested. For Josh, this matters because volatility isn't an exception, it's part of the deal. The real risk isn't temporary declines, it's abandoning the strategy when they happen. Modern data tells the same story. Vanguard's research from July 1995 through June 2025 shows that U.S. equities turned $10,000 into about $214,332, compounding at roughly 10.8% per year. Over that same period, inflation reduced $10,000 held in cash to about $21,911 in real purchasing power. Other growth assets followed similar patterns, while bonds provided stability but limited wealth creation. This evidence explains why Vanguard's philosophy prioritizes broad market exposure, low costs, and disciplined participation rather than prediction. For Josh, the implication is clear. He doesn't need dozens of investments. He needs growth that beats inflation, stability that keeps him invested during downturns, and enough time for compounding to work. Most portfolios aren't built with that reality in mind, and that's where the real problem begins. A lot of investors think picking ETFs means finding whatever performed best recently. That approach looks smart on paper, but is how portfolios break under pressure. ETFs aren't individual stocks, they're systems, and if the system is weak, strong recent returns won't save it over time. The first thing that matters is cost. Fees compound just like returns, except they work against you. An ETF that charges 1% doesn't sound expensive, but over decades, it can cost you hundreds of thousands of dollars in lost growth. That's why low expense ratios are non-negotiable. The second filter is survivability. A high-quality ETF must be built to live through multiple market cycles. That means broad exposure, clear rules, and no dependence on trends that come and go. If a fund only works when conditions are perfect, it won't hold up when markets turn against it. The third filter is role clarity. Every ETF in a portfolio needs a specific job. Some are designed to drive growth, some exist to provide stability, others generate income. Problems start when investors own multiple ETFs that all do the same thing. That creates overlap, not diversification. The final filter is intentional concentration. Diversification spreads risk, but concentration can help when it's applied where long-term returns are actually generated. Certain areas of the market have driven a large share of historical growth. The key is knowing where concentration helps and where it increases unnecessary risk. When you apply those filters, most ETFs disappear. High fees drop out, overlapping funds drop out, anything built on hype drops out. What's left are 3 low-cost funds, each with a clear job, that actually work together across different market conditions. Let's start with the first ETF, which sets the portfolio foundation, and for that, you need a total market ETF. VTI is the Vanguard Total Stock Market ETF. Its job is simple: own the US stock market as it actually exists. It does not attempt to outperform the market or adjust exposure based on forecasts. Its role is structural: capture long-term US economic growth as efficiently as possible. That is why it serves as the foundation of this portfolio. VTI holds about 3,541 US companies. That includes large companies everyone knows, but also mid-size, small, and even micro-cap businesses. It's not picking winners, it owns the whole system. That mix changes automatically as companies grow or shrink. Right now, technology makes up about 1/3 of the fund because that's where market value sits today. Financials, healthcare, consumer sectors, communication services, and industrials fill out the rest. The top 10 companies make up about 34.75% of the fund. That number sounds high until you understand why it happens. VTI weights companies by size. Bigger companies take up more space. When leadership changes, the fund adjusts on its own. No decisions needed from Josh. Over the last 10 years, this approach worked. VTI delivered about a 243% total return. In practical terms, that means if Josh had invested $10,000 10 years ago and did nothing else, that investment would be worth around $34,000 today. This result comes from broad market exposure and disciplined index tracking, without relying on active trading, stock selection, or market timing. Risk, however, is inseparable from equity ownership. VTI is 100% invested in stocks, which means volatility is expected. Over time, the fund's annualized volatility has been about 19.35%. That number simply describes how much prices tend to move up and down in a normal year. Its standard deviation sits around 11.46, which is slightly higher than the average ETF, not because of leverage or concentration, but because it fully reflects stock market movement. In real life, that shows up as drawdowns during market stress. In 2008, US stocks fell close to 40%. In 2022, markets dropped sharply again as inflation and interest rates surged. These periods weren't malfunctions, they were the costs of owning equities. Despite that volatility, VTI scores well on structural risk efficiency. Turnover is about 2%, which means almost no trading. Tracking error stays low, meaning the fund closely follows the market instead of drifting. That's why its risk profile fits its role in the portfolio. This is reinforced by its B+ risk grade, reflecting volatility that is appropriate for its role rather than excessive for its construction. Income plays a supporting role. VTI currently offers a dividend yield of about 1.12%, which is lower than the ETF median, but intentional given its growth orientation. More important than yield is consistency. Dividends have grown at a 6.16% compound annual rate over the past 10 years, supported by 24 consecutive years of dividend payments. This steady income growth enhances long-term compounding without sacrificing capital efficiency. Costs remain one of VTI's strongest advantages. The 0.03% expense ratio earns it an A+ expense rating, meaning nearly all gross returns remain with the investor. Over multi-decade holding periods, this cost discipline compounds into a meaningful advantage relative to higher fee alternatives. VTI does one thing well. It captures broad market growth at an extremely low cost. It doesn't smooth volatility, and it doesn't push returns higher on its own. That's why it's the foundation, not the entire structure. To move beyond average market growth, the portfolio needs a second piece that takes more risk on purpose, and that's where the next ETF, VGT, comes in. After that, I'll walk through one more ETF in the portfolio, and then in the end, I will show how this structure could potentially turn Josh's $7 a day into a portfolio worth $1 million over time. But first, let's look at the growth side of the portfolio, VGT. VGT is the Vanguard Information Technology ETF. It is designed to provide targeted exposure to the US technology sector through a transparent, index-based structure. It does not attempt to rotate between industries or moderate risk through diversification. Its purpose is singular: capture the long-term growth generated by technological innovation and market leadership. Within this portfolio, VGT functions as the growth engine. VGT holds approximately 328 companies with over 98% of assets allocated to technology-related businesses. Unlike a broad market fund, sector exposure here is intentional rather than incidental. The portfolio is heavily weighted toward dominant platforms and infrastructure providers that sit at the center of the digital economy. NVIDIA, Apple, and Microsoft form the core, and the top 10 holdings account for roughly 59% of total assets. This level of concentration reflects market leadership and capitalization, not active discretion, but it does increase sensitivity to the performance of a small group of companies. Historically, that risk has been rewarded. Over the past 10 years, VGT delivered a 652.8% total return. That means if you invested 10 grand and stayed invested, that money would have grown to roughly 75 grand. Even over the last 5 years, the fund returned about 117%. Those numbers didn't come from timing or luck. They came from concentrated exposure to companies that grew earnings faster than the broader market. That return profile comes with materially higher risk. VGT exhibits annualized volatility near 28% with a standard deviation of approximately 20.6, placing it well above the median equity ETF. This elevated volatility is structural. Technology stocks tend to react more aggressively to changes in interest rates, liquidity conditions, and growth expectations. As a result, drawdowns during market stress are typically deeper and faster than those experienced by diversified equity funds. This risk profile is reflected in the fund's D+ risk grade, indicating higher than average volatility relative to peers. Despite this, turnover remains moderate at around 8%, supporting consistent index tracking rather than speculative trading. Income is not a core objective for VGT. The fund currently yields about 0.4%, and while dividends have grown over time, the 10-year dividend growth rate is only around 1.76% annually. This reflects a technology sector that prioritizes reinvestment over payouts. Any income generated is incidental and does not materially impact long-term returns, which are driven almost entirely by capital appreciation. Cost efficiency remains a supporting strength. The 0.09% expense ratio earns VGT a strong expense rating relative to sector-focused funds, ensuring that the majority of gross returns remain with investors. VGT provides concentrated growth potential but accepts elevated volatility as the trade-off. It is not designed to stabilize a portfolio or deliver income. Its role is to amplify long-term returns. And because that upside comes with sharper drops, the portfolio needs one more piece to balance it, which brings us to the stabilizer ETF, Vanguard Short-Term Corporate Bond Index Fund ETF, or VCSH for short. This Vanguard ETF is designed to provide capital stability and reliable income rather than growth. Its role in the portfolio is defensive and behavioral: reduce volatility, generate cash flow, and make it easier to remain invested during equity market stress. This ETF does not attempt to forecast interest rates or enhance returns through active management. Its mandate is simple: deliver short-term, investment-grade corporate bond exposure as efficiently as possible. VCSH holds about 2,638 bonds, mostly issued by high-quality U.S. companies. Nearly 99% of the fund is invested in corporate bonds, with small amounts held in cash and government securities to keep things liquid. The top 10 holdings make up only 2.01% of the fund. That means no single company can meaningfully hurt your results. Risk is spread widely, and behavior stays predictable. From a performance perspective, VCSH is intentionally muted. Over long periods, price appreciation has been minimal, with roughly 0.1% annual share price movement. Over the past 10 years, total returns have been modest, and the 5-year period shows mild declines due to the sharp rise in interest rates. This behavior reflects duration exposure rather than credit deterioration. Short-term bond funds tend to reprice when rates rise, then stabilize as higher yields reset future income. Risk control is where VCSH excels. Annualized volatility is approximately 2.21%, with a standard deviation of 1.26, far below equity ETFs and even longer duration bond funds. Risk grading places VCSH in the A+ category, reflecting extremely low volatility, minimal concentration, and strong diversification. Tracking error remains low, reinforcing the fund's consistency in replicating its underlying index. During equity drawdowns, This stability helps cushion portfolio declines and reduces the likelihood of panic-driven decisions. Income is the core function of this ETF. VCSH currently provides a dividend yield of about 4.35%, paid monthly. More important than yield alone is growth and reliability. Over the past 10 years, dividends have increased at a compound annual growth rate of approximately 8.18%. The fund has delivered 16 consecutive years of dividend payments and 4 consecutive years of dividend growth, earning it a B+ dividend grade. This income can be reinvested, used for rebalancing, or drawn during market stress without selling equities. Costs remain low and efficient. The 0.03% expense ratio earns an A+ expense rating, ensuring that income is retained rather than eroded by fees. VCSH isn't designed to make you rich on its own. Its value is stability. It reduces swings, produces cash flow, and makes it easier to stay invested when stocks are under pressure. And when you put all three pieces together, that's where the portfolio starts to work as a system instead of a collection of investments. Here's how it works in practice. Each piece does something different, and none of them is trying to do the other's job. Half of your money sits in VTI. At 50%, it gives you broad exposure to the US market. That portion currently produces about a 1.12% dividend yield, with dividends growing around 6.16% per year over the last decade. On the growth side, it delivered about 13.59% annual share price appreciation, which captures long-term economic growth without needing constant decisions. Then 35% goes into VGT. This is where returns get pushed higher. That portion has delivered about 21.64% annual price appreciation, driven by concentrated exposure to technology. The dividend yield stays low at 0.4%, and dividend growth sits around 1.76%, because this part of the portfolio is built for growth, not income. The remaining 15% sits in VCSH. This is what keeps the whole structure stable. That slice provides a 4.35% dividend yield, with income growing about 8.18% per year over the last 10 years. Price movement stays near 0.1% annually, which means this part doesn't swing much when stocks do. When you combine everything, the portfolio produces about 1.35% dividend yield, with dividends growing roughly 4.92% per year and an annual share price appreciation of around 14.38%. Now let's look at what the projections show when consistent contributions and time are added. Let's say Josh contributes $7 per day into this portfolio. That works out to about $210 per month, invested consistently without changing the strategy. By year 10, the portfolio is projected to be valued at around $52,000. At this stage, most of that growth still comes from Josh's contributions, not compounding. As time goes on, the balance starts to shift. By year 20, projections place the portfolio near $257,000, generating roughly $500 per year in dividends, with compounding now doing more of the work. Then, in the final stretch, the acceleration becomes clear. By year 30, the portfolio is projected to exceed $1.048 million, producing approximately $700 per year in dividends. By that point, Josh's total contribution would be around $76,650, meaning the majority of the portfolio's value is projected to come from compounding rather than the money he put in. Want to see how Josh turns a $10 daily investment into a $1.5 million portfolio that pays over $9,000 per month in dividend income? Click the video on screen to find out.